Welcome to the Crypto Conversations, hosted by the Columbia Center for Digital Finance Technology. And I'm pleased to host this series together with Professor Fahad Saleh from the University of Florida, who is also the cryptocurrency economic advisor. And I am Agostino Capponi, and I'm the director of the Center for Digital Finance Technology. So today we are pleased to have with us Chintan Turakhia, who is the director of engineering and the head of the Base app at Coinbase. And he's like a technologist, and he has been working and leading a lot of global engineering teams to basically harness and create the best technologies. And today he's going to share with us some insights about the Base app and digital wallets. So I would like to start this conversation, Chintan, with you, maybe saying a bit more what is really a digital wallet, just to make sure that we are all on the same page here.
Yeah. First of all, thank you so much for having me. Really excited. Hello to everyone. Okay, digital wallets. What are they? I think everyone already understands or should already understand digital wallet. I think iPhones do a great job. Google does a great job. You walk into a coffee shop, your credit card is linked up. You tap on some terminal and you make a payment, right? So many people are already familiar with digital currency, and it's made life a lot easier, and that's great. But when it comes to sort of crypto and crypto wallets and self-custody wallets, I totally get a lot of these terms are foreign and new to people. And so what's the difference? So when we think about crypto, and self-custody wallets, the biggest change in the way it's like a paradigm change in the way sort of digital money moves is that with these crypto wallets, with these self-custody wallets, the assets belong to you. And I want to unpack that more, because it's actually a very sort of foreign concept, especially if you've grown up or used to the banking system in the US, where you give your money, you put it in a bank, the bank does stuff with it that you may or may not know, and that's fine. But your assets are there. But in reality, the bank is the custodian of your assets, right? And you go in to the bank. When it's open, you can go into the bank and withdraw those assets. Or if you need to go to an ATM, when the ATM is open, you go to the ATM and withdraw those assets. Or you can go to the website. If when the website's working, you go and withdraw your assets. But I'm sure many people have run into scenarios where banks are closed, ATMs closed, the website may not be working, or there's something going on. There's maybe just some hold or something. And you can't get the money that is actually your money, right? And there is a place, the banking system has worked that way for a long period of time, and that's great. That's why we're here today. And with the introduction of blockchain and these immutable ledgers and cryptocurrency, there's also a new operating paradigm, which is called self-custody. And so what self-custody means is you yourself are the custodian of those assets, right? And the way that works is it's actually, the reason for that is actually more important than the way it works. It enables people to be self-sovereign. They can be their own bank. No one is telling them when or when they can't move that money. No one is telling them when or when they can't withdraw that money, right? If they need access to the money, it's theirs. It's right then and there. And it's all backed by cryptographic key material, right? And the beauty of this, and what blockchains are designed to do, what crypto is designed to do, what Coinbase's mission is to enable economic freedom. And what that actually means is the ability for anyone in the world, no matter where they are, to actually improve their quality of life through better economies. And those better economies are governed and made possible by the free movement of value, the free movement of capital. And if a bank is holding that capital, the movement of that value is very hard. So just always go back to the simple example of, if I want to move money, if I want to send money to someone on the other side of the world, if you've done that recently, it's really hard. You gotta do a wire transfer, then it hops through multiple intermediaries. And if you're sending money to Argentina, for example, by the time it gets to Argentina, the money's like lost like 20% of its value, for example, in these very high inflationary countries. So these digital wallets that are self-custody, meaning you own the assets and you control what you can do with them. And if you lose the key material, you lose the asset, but it's your responsibility. With digital wallets that are self-sovereign, that are self-custody, it does enable anyone to move value on their terms, using their own assets, using their own security and privacy. And I think that's like the beauty and value proposition there for self-custody wallets.
Right. So that sounds pretty cool. But it is, so yeah, no, I of course it is pretty cool. But you know, one of the things that usually comes up from I think people in more TradFi settings is, or people who are in more TradFi positions, is to say, well, but users don't properly understand what's going on, and so the bank, for instance, might be essentially substituting or playing a role in that regard. And so what I'm saying is that because you mentioned, for instance, cryptographic proof, right? And that's kind of a tricky concept for you know, typical users. So how do you think about the trade-off between essentially having the freedom of self-custody, but also having the responsibility of self-custody in some sense?
Yeah, and I think it always boils down to this trade-off, right? Like self-custody may not be for everyone. It may not be for you. It may not be for, you know, someone. And I think like if you think about like really the bookends here, one bookend is pure self-custody, right? You open up like the real bookend is like you don't even have like sort of any software. It's actually like you just have the wallet address and the seed phrase, right? The cryptographic key, and like it's never become a hot wallet. It never touches the internet, but that address exists, right? All addresses exist, and that's one bookend. The other bookend is you give custody to some custodian, right? Like Coinbase Exchange is a custodial solution. It's a great one. It's trusted. It's regulated. It is designed to work with the law, right? Wherever it operates. It's designed to be user friendly. It's designed to help people new to crypto understand what's going on. Like I'm an extremely big believer in that if we want new technology adoption to happen, you also have to meet the users where they are. And you have to bring them along the journey. And you can't start with like, hey guy, hey gal, have you heard of crypto? Do you know what self-custody is? It's like, we tried that. It doesn't work. It's like, it's a dead end, because then you have to like back up and be like, whoa. Like, I don't understand this concept. I use a bank. Why do I need this other thing? Right. And so we found the most effective way, like to help people gain the benefits of digital assets that can be moved freely across the world with no cost. You introduce them to like why moving value at the speed of light with zero cost is important, right? And then explain like the existing systems we have today are just full of middle people taking a cut. And it's designed like, that's okay. That's how it was designed. And now we have new technology that allows, you know, people to move value anywhere they want instantly, right? You had postal mail, we had email. We had traditional banking, we have digital assets on a global public immutable ledger, right? And so people can start with custodial options. I think that's great. That's huge. Even like ETFs are like even a different flavor of what I'm talking about. And then we see people over time, we're like, oh, like, let me try self-custody. And there should be a reason for it, right? I think, very honestly, at least in the US, maybe there's less of a reason. It might be just more like the user is very particularly interested in self-custody for privacy reasons, etc. But in countries where like banking systems may not be as trustworthy or as reliable, there is a real reason for self-custody. And you'll find when you talk to people from different parts of the world, many folks already know what like self-custody is because they have had a terrible experience where the bank has taken their money, locked their money. Maybe it's a war-torn country and they've had to like move and lift and change their lives and move to a different place. And that's how they move their money.
Yeah, so this makes me think of an analogy with the traditional banking system, as you pointed out. Now, when we trade over the counter, like there are always custodian of collateral. You have to post collateral, and then this collateral is typically held in custody at some of the banks. For example, BNY Mellon was a big, or is still a big of custodian of collateral. And I think one of the reasons is exactly that you want to make sure that there is zero counterparty risk, that this collateral is secure, it's well maintained, and it can be liquidated on a short notice if needed. So I'm thinking in making an analogy with the crypto assets where you have self-custody. I mean, do you view this primarily, as you mentioned, like a situation where you can maintain privacy and you have actually zero counterparty risk exposure because now you hold your assets directly, or you think there are additional benefits, for example, in holding this asset
Yeah,
in self-custody? So is it probably the question is more, is it just counterparty risk and privacy consideration, or there are other reasons that are valued?
Yeah, I mean, I think like counterparty risk and privacy are important, and it's important for different reasons to different people. I think the other sort of benefit of self-custody, especially as like regulations are becoming more clear in US and other regions, like I think some of the benefits of self-custody are just the fact that you can participate as a user in a global economy, global capital markets, right? Where some people like, if I wanted to use Coinbase, I would have to live in a country where Coinbase exists, where Coinbase is supported. And even for banks, like I would have to live in a country where I actually trust the bank, right? And someone like, these larger institutions, they have years of trust, right? And that's really, really important. But there are people, for a global economy, people that just don't have access to that same type of institution, same type of trust mechanism, even same type of just technology out there, right? Some people may not even just have like an ID for what we know, right? And so that goes to like the KYC, the know your customer process. And so I think self-custody is also important for just the ability for anyone in the world to be able to download software, right? Many people, like most people in the world, have some type of mobile device or access to some type of internet software, download software, create a wallet with one button click, and then be able to get access to a global capital market, right? And then we start seeing these primitives of DeFi, of lending, of borrowing, of just even like simple things like payments, which is such a huge use case, like flourishing. And I think it's actually the utility. And like for many years, right, crypto has gotten a bad rap for like a lot of the speculative things going on, right? And recently, over the last few years, we've seen so much more utility come through because the UX has gotten better, because it's gotten cheaper, because it's gotten faster, because institutions are adopting it, which is also driving interest, which is also driving use cases. And so now benefits of self-custody are also just the use cases it unlocks and the speed at which you can start using a use case, like payments, like DeFi, like lending, like borrowing.
So you touched on the wider array of use cases beyond payments there, and Agostino and I would like to sort of get into that in a bit, but I wanted to ask you just sort of one last question on the earlier points, which is, so I can imagine, a lot of people listening to this thinking that they see a lot of value in self-custody, and even in the developed world. I personally think there's a lot of value in self-custody, and I live in the developed world. I self-custody. So, but I could imagine some of those same people who might have that thought would say, but I feel like I don't know enough in order to do this, even through an app. And so part of what I'm wondering is, what would you recommend for somebody who sees the value of it, but is a little bit, who feels like they should know a little bit more? Like, are there resources or are there specific things that you think that would be good for them to sort of look into to make themselves more comfortable with what it is that they're doing, so that they can sort of access all those benefits that you were talking about, which I think are clear. And there are probably many people who would say, it sounds like something that I should be doing, subject to me having a sufficient understanding.
Yeah. I mean, there's lots of great resources out there. Tutorials, things on YouTube, websites, et cetera, et cetera. And so there's no shortage of people and their ability to go and learn what self-custody is. But I think self-custody in itself is not the use case. Self-custody is a means to an end. And historically, I spend a lot of time just onboarding people, in real life, right? Cafes, events, etc., just to really see where the friction is. And a lot of the times the friction is, it's funny, the friction just comes when we start opening our mouths and explaining crypto, honestly. Really, if you want someone to understand the value of crypto, you kind of just got to show them how it solves a problem that they themselves are facing, right? And so with my friends, with people on the street, the approach of hey, have you heard of self-custody? Have you heard of crypto? Doesn't work so well. But when people hit sort of, oh, I want to pay my family in Mexico, for example, and they walk into a place that does wire transfers and they pay a $30 fee, explaining that there is a better system is so valuable. And then you show them how self-custody can get that money in their hands to maybe their family in Mexico instantly for free. And so I think the best way for anyone listening to this to try, if they want to try self-custody, is actually go talk to either a friend that's already using a wallet and have them show you a use case, or just think about your day-to-day stuff that you're doing. If you're paying someone with Venmo or PayPal, or if you're trying to move money across borders, if you are doing these actual use cases where crypto actually provides a better path, that's really when then you start appreciating oh wait, there is a better way to do this, and it happens to be done through self-custody.
Yeah. So basically, to summarize, it reduces a lot of frictions that you have to incur on a day-to-day basis.
Yeah. And you can't appreciate the friction if you've never actually faced the friction yourself, right? And so it's all just about really focusing on your day-to-day use cases and challenges. And like I said at the beginning, if you're not facing this friction, if you don't have to move money across borders for now, or do some of this stuff, you may not appreciate the value that a digital self-custody wallet provides you today. And it may just be something exploratory and fun to play around with, and that's okay too, right? And so there's a whole genre of other use cases like games, prediction markets, we're seeing stuff that we're actually building in the Base app, which is actually driving more and more different types of new consumer-focused use cases too.
Now, switching a little bit gear, I would like to start discussing a little bit about smart wallets. And I would like you basically to give a bit an overview and explanation of smart wallet. And also, as we have seen, there has been a recent upgrade by Ethereum related to smart wallets, the EIP 7702. So I wonder, what do you think about how this wallet experience offered by Coinbase is going to evolve going forward in light of this?
Yeah, we're big fans of smart wallets. In fact, the Base app is powered by a smart wallet. And big shout out to the team here at Base that built out more than a year ago smart contract wallets that use passkeys. And so for the audience, I'm just going to take a real quick second as a step back. What am I talking about, first of all? So for a self-custody wallet, right, the thing that the software of a self-custody wallet or digital wallet provides is very simple. It just does three really basic things. One, it stores the cryptographic private key. Okay, so there's a key that is generated locally on the wallet itself, and it just stores that and makes sure it's secure. And two, it uses that key to sign a transaction. If I want to send $5 of USDC to you. The wallet itself will prepare like all the parameters for that transaction, and it would use that private key to sign it and submit it to the blockchain. And the third piece of a digital wallet is just being able to see what's on the blockchain, like your balances, things like that, right? Very, very simple. Okay. Now, what are smart wallets? So historically, there have been this type of wallet called an EOA. It's like an externally owned account. It uses like a 12 or 24 word seed phrase. And like, this is how that cryptographic material gets generated. The downsides of these like EOA wallets historically is like, it's very hard to sort of reprogram them, right? It's very hard to like help them adapt to like improvements in technology, because you're the only person on earth that should know what those 12 or 24 words are, or what that private key is. And so challenges we saw users facing when they were using crypto products, and what made the user experience hard, is really around one, like users would, when they wanted to do a transaction, they would have to pay this thing called like gas or a network fee. It's effectively like a little bit amount of a token to incentivize the blockchain to like effectively mine and prove that this transaction is legit. And it's a very, very confusing experience when you want to try to get a user onboarded, and you have to like, you give them an NFT or you give them some USDC, and then they go try to use it, and they're faced with this sort of message that says, well, hold up there. You want to send this money, you need to pay some network fee. And like, to users, they're like, wait a minute, what is this network fee? Right? It's like, I need to pay a fee to send this money. Like this is crazy. This doesn't make sense, right? And that's like one of the biggest things with smart wallets, where like you can actually just have someone else pay the network fee, like a paymaster. And so it starts abstracting these challenging user experience concepts, starts abstracting them away from the user. User also doesn't have to manage like this private key. They can manage it in a more simpler way. There's no seed phrases. Sign in becomes very simple. You just push a button and like, boom, you see a passkey prompt like you would see on an iPhone. You're signed in. So you can have different signers, right? You can have like email signers, passkey signers, all sorts of different signers. So it starts opening up the design space and the creative space for better user experience. That's what smart wallets are. Programmable accounts, no seed phrases, simpler sign-in. And it really has helped us leapfrog the UX, the user experience for crypto consumer products, where we can get the user to the value much faster. We don't need to worry about like weird things like gas. Sign-in feels easier. It just feels much more like a regular consumer app that happens to use crypto behind the scenes. So that's what smart wallets really are. And we use it in our base app. It's made signing in, it's made onboarding much faster, much easier. Folks don't have to worry about this process. Like, oh, wait, here's this 12-word seed phrase. Please write it down or the world's going to end. Like, none of that has to happen anymore. So it's like much more user-friendly. And so we love like smart wallets and how they've been adopted. And it's really been pushing the consumer UX for crypto in the right direction.
So just a quick clarifying question though on that. So is every every user who is using the base app, are they essentially tied to a smart contract on the chain?
Yep, that's right.
Okay.
Yeah. So when a new user opens up the base app, they create we help them create a smart wallet behind the scenes that's tied to a contract. And right now, the signer for that, like the way they sort of verify, is a passkey. But we're also going to add different other types of signers as well, like email and things like that too.
Perfect. And just going back to the question about the Ethereum upgrade, the EIP 7702, do you think this has any impact on the base app?
It does. So this EIP 7702, really, it very simply does one thing. It lets someone who has sort of this legacy EOA wallet, like the seed phrase type of wallet, it lets them upgrade that EOA wallet to operate and be controlled by a smart contract. That's all it is. So then they can inherit the benefits of programmability, about sponsored gas, and inherit all these other sort of primitives that smart wallets bring to the table. And so it's important for the base app because we have a huge number of legacy Coinbase wallet users that have an EOA, and we want to bring them into this new world.
But so just so I understand, in terms of going forward, obviously before the Petra upgrade, you wouldn't have been able to essentially have somebody have an EOA and yet have sort of this kind of advanced functionality. Obviously, after that, you now can. But so the way I took your answer to be was sort of like, well, now we can bring people on board who couldn't, in essence, at least in the sense of like their literal EOAs couldn't transfer. I guess they could open a separate smart wallet with you. But I'm wondering, just in some sense, what is better in the long run? Like, do we really need EOAs in some sense? I guess is what I'm asking going forward, or is it advantageous to actually have them initially have an EOA and then sort of upgrade it to a smart contract account? And part of what I'm wondering here too is, so if in the other case, if in the prior case that you would essentially have a smart contract on chain that was like that essentially corresponds to the wallet, then the sort of the logic of that smart contract presumably has some, feasible region of things that it can do. And if you wanted to expand that, I guess you would need another smart contract or something like that. And in some sense, the 7702 makes that step easy, right? Like I can just upgrade to a new smart contract. So yeah, could you give some context on how you're thinking about sort of the design of these things going forward, given the ability to have EOAs and then upgrade to different smart contracts over time?
Yeah, so like again, this is like a user choice as well. Like some users may be like, hey, I don't like. I'm going to keep my EOA separate. I don't want to upgrade it to a smart wallet, smart contract based wallet. I'm just going to spin up a brand new smart wallet. That's totally fine. Some users were like, hey, actually, there's a lot on my EOA. There's a lot of history. And I kind of just want to keep it all the same. I have it set up nicely and they want to upgrade. And they can also just remove, they can unupgrade or downgrade. They can remove the contract ownership from the EOA itself too. And then, yes, over time, like as contracts are changing, as we need to make updates, we can use this technology to keep advancing the features we provide to users. And so like, it really just depends on what the user wants. But a lot of this is really for a cleaner, simpler user experience.
Good. Yeah, so this is very helpful. So I'm thinking like if maybe you can provide your perspective on how you think the smart wallets are going to affect the business strategy of Coinbase and more generally like the user experience going forward. Do you think this would be some kind of game changer in the space?
I do think it's a game changer. I think it's allowed. Even us as a company to be able to offer more on-chain product offerings on our retail exchange, on the main exchange, right? The Coinbase.com app, where previously we had like one type, in addition to the custodial piece, right? We recently introduced swaps, like DEX swaps, right? And that is powered by some of the smart wallet technology we're talking about here. And it's been made it much easier to sort of start bridging these things, the boundaries between custodial, self-custodial, semi-custodial, et cetera, and has allowed us to move the technology faster as well. And from that, we've seen like better adoption because the UX is much more clean. It's faster. Onboarding is easier. We don't have to push people through like a seed phrase experience where they have to write everything down. And there's also so much more room to go, right? Like the crypto UX and consumer UX for crypto, what it's competing with is like the sign in with Google buttons, the sign in with Apple buttons, which everyone's used to that. It's very good, very simple. And that's sort of the direction of travel that we're all headed. And you can also see some of that with like awesome companies like Privy, right? They have sort of an email approach to wallets. that they've built, and it's great. And so that is the direction of travel where things will go to.
So I just want to ask a clarifying question. I heard you say that you allow for DEX swaps. So first, I want to clarify that. So for instance, if I want to essentially liquidate some Ether, but I want to, or let's say I'm buying something from a merchant. Let's say Agostino is a merchant, and I only have Ether in my wallet, but he says he only wants to take USDC. So when you say DEX swap in that context, for instance, is it feasible right now through the base app for me to basically pay Agostino in USDC, even though I don't have any in my wallet, because I have Ether and I can do a DEX swap essentially, or there'll be basically a DEX swap that happens right before the funds go to Agostino.
Yeah, got it. Yep. So like you as the payer and Agostino as the receiver, you guys shouldn't care who has what. Agostino can get what he wants, and you should be able to use what you want. So yes, that is a goal. So like, there's one thing about DEX swaps, which is like native swaps, like just swap USDC to Ethereum, right? That always exists. That's fine, but that almost feels, historically, it's almost felt just like a stepping stone to the actual thing, which is like in actually a P2P payment scenario. Neither side should care, and the swap should happen sort of behind the scenes, and the USDC or the Ether should land to like Agostino, right? We will have that pretty soon. The technology is there. It's just a matter of like getting it out the door for us.
So I just want to provide a little bit of context on the significance of something like that, by the way, because for the longest time in economics, we've talked about sort of needing money because barter is inefficient. And even in our economic models, we include things what we call like cash in advance constraints, where we say, users or consumers have to hold a bunch of cash because they've got to go to the grocery store, and the grocery store is going to say we need to be paid in dollars. Whether it's digitally through Google Pay or what, it's still dollars, right? But from an economic perspective, it actually induces a welfare loss that you're now saying, well, people have to basically keep this cash that's not actually part of their optimal portfolio. And yes, that's better than like barter in the sense that I don't want to be running into the coincidence of wants problem. But essentially, what you're talking about, I like to refer to as frictionless barter. And it turns out frictionless barter is actually better than using a coordination device, which is what money actually ends up being. Money is just the coordinating piece of paper or whatever that we decide to use so that we don't have the coincidence of wants problem. But it creates this sort of this friction, this welfare loss due to this cash in advance constraint, because now I have to hold that thing, and it's not particularly useful to hold it in a vacuum. And so if you get to where you're talking about, you basically ended up in a world where I can hold my optimal portfolio at all times, and I don't have to worry about, hey, does Agostino happen to accept whatever happens to be interesting to me to hold? Because we will just immediately access liquidity on chain, and we will be able to have him get what he wants, and I will be able to keep whatever I want. And so from an economic perspective, there's a significant welfare advantage. And by the way, we've been talking a little about the developing world versus the developed world. Like even in the developed world, that's a massive welfare advantage, because this is one of those things that it basically applies to everybody in the world, essentially, right, including the developed world and the developing world. And so even if you think like the welfare gains per person are very small, there are a lot of people on the planet, right? So there's a lot of value out of that.
Yeah, I think that's like so important, because everyone should be like, we started this whole thing about self-custody. People should be able to do what they want with their money, period. It is their money, right? And so if I want to hold everything in USDC and earn some, yield or interest on that, great. And if I don't want to be exposed to the volatility of non-stable coins, that's my prerogative, right? And if Agostino wants to accept Ether, that's awesome too. And neither of us should care. And that's honestly like one of the coolest things to come out of all of this, right? This technology that just lets that kind of value transfer happen fast, cheap, seamlessly between two parties, and there is no middle person taking their cut, because the technology exists, and yeah, it's great. I'm like, it pumps me up.
Right. So I would like to basically take a moment here to conclude. I think we had a very interesting conversation. I would like to thank Chintan for joining us and sharing like these great insights in terms of like how technology is leading us going forwards. I think we touched upon very, very interesting topics like self-custody, smart wallets, and I think the common denominator seems to be that we can basically get rid more and more of intermediaries, improve user experience, and essentially have better and better technology for our day-to-day life, right? Aside, well and beyond crypto. So with this, I would like to conclude. I would like also to thank my co-host Fahad Saleh for leading this discussion, and there will be new episodes to come, so stay tuned. Thank you.
Thank you.